If you've ever just stared at your bank account and wondered, how on earth do I make this money actually work harder for me? Well, you've probably stumbled right into the great debate of time horizons. Okay, let's dive into this explainer. Today we're breaking down literally one of the most fundamental choices you'll ever make as an investor: long-term versus short-term investing. We need to figure out which one actually aligns with your life, your specific goals, and, honestly, your stress levels.
Because when you're first stepping into the financial world, it's so incredibly easy to fall for a bit of an illusion. So many beginners view the stock market as this wild sprint for overnight riches, right? They're chasing hot tips and instant payouts, kind of treating it like a casino. But the reality? Genuine financial independence is pacing yourself for a marathon. Building real wealth is rarely a sprint. So today, we're going to objectively look at both of these paths so you can decide exactly which track you want to run on.
So here is our roadmap for today. Number 1, the marathon versus sprint. 2, the compound machine. 3, the high-stress sprint. 4, the head-to-head decision. And finally, number 5, the core and satellite solution. Let's get right to it.
Section 1, the marathon versus sprint. Before we get into the weeds, I really want you to ask yourself, are you sprinting for immediate income right now, or are you running a marathon to build lasting wealth? Keep that in mind.
Section 2, the compound machine. Okay, let's move to and see how this builds, taking this whole idea of long-term investing from being quote-unquote boring into a truly powerful passive wealth-generating engine.
So, the absolute core of the long-term game relies on the single most powerful force in finance: compounding. Basically, this is the process where your investment earnings actually begin to earn their own earnings over time. You aren't just making money on your original cash anymore. You are literally making money on the money your money made. It's exactly like a giant snowball rolling down a hill. It just keeps gathering mass and speed. And the best part is, you don't even have to push it.
But here is the catch with compounding. It demands time. In year 1, your gains might literally feel like pocket change. It requires real patience to weather those early, uncomfortable market dips and short-term crashes. But then you hit year 5, and the market growth really starts to build. And by year 10 and beyond, wow, that is where the gap between your original principal and your compound interest widens drastically. Historically speaking, the longer you just stay in the market and let those business fundamentals work in your favor, the lower your chances are of actually losing money. You just gotta wait it out.
So what does this actually look like in practice? Well, common vehicles for a long-term approach include things like index funds, ETFs, blue chip stocks, retirement accounts, and property. Now, the huge selling point here, and this is absolutely crucial, is that you do not need to stare at charts all day long. This is a totally hands-off approach. It means lower stress, fewer transaction costs, and generally far lower taxes because you aren't constantly buying and selling. You literally just buy, hold, and let the market do all the heavy lifting for you.
Section 3, the high-stress sprint. Now let's pivot to the short-term reality, which is an incredibly active and thrilling strategy focused tightly on near-term price movements.
Short-term investing operates on a vastly different horizon. We're talking days, weeks, or months, but typically less than 1 year. Now this strategy is highly liquid. If timed perfectly, and that's a big if, it's great for near-term goals. Maybe you want to fund a holiday, or you need some quick cash for a car. In this space, you are actively trying to profit from near-term price movements, rather than waiting around for long-term business growth.
But there is a pretty brutal truth to the short-term sprint, and beginners often fall right into these hidden traps. First up, the massive time commitment. This requires daily, active monitoring and a genuinely solid grasp of technical charts. Second, the market is highly volatile and just completely unpredictable in the short term. And third, actually, this is the one people almost always forget until it's way too late: frequent transaction fees and higher short-term capital gains taxes. Seriously, every single time you buy and sell, your profits are getting chipped away at. It's genuinely surprising how quickly those fees and taxes can completely obliterate tiny, hard-won profits. Now, what's really interesting about this slide is, well, it's a massive reality check. Multiple studies show that over 80 to 90% of day traders actually lose money over a 1-year period. Let that sink in. 80 to 90%. For a beginner without any real experience, treating the market as a short-term play is honestly a lot closer to gambling than it is to actual investing. Section 4, head-to-head decision. Let's directly contrast these two paths so you can figure out what fits your actual lifestyle.
So the crucial point is, there really is no universal best strategy out there. It entirely depends on your personal goals, your specific timeline, and of course your risk tolerance. Let's break it down.
If your time horizon is less than a few years, and your primary goal is quick cash for, say, a vacation, you are squarely in the short-term column. But you have to accept the high risk and the high effort that comes with it. Honestly, if you need the money that soon, you might even just want to stick to high-yield savings accounts or CDs just to protect it. Conversely, if your horizon is 5 to 20 plus years and your ultimate goal is financial freedom, you absolutely belong in the long-term column. The risk is lower because time naturally smooths out those market crashes. And the effort? It's incredibly low. You can literally just automate your purchases into index funds and ETFs and forget about it. At the end of the day, your time horizon dictates the winning strategy here. You absolutely must know when you'll need the cash before you choose your path.
Section 5. Core and Satellite Solution. Here is the ultimate tactical takeaway, so you don't feel completely boxed into choosing just one absolute path.
Because guess what? You don't actually have to choose just one. And this brilliantly illustrates the hybrid strategy known as the core and satellite approach. Imagine your entire portfolio divided up like a pie. The massive slice, 80 to 90% of your money, is your core. This is your safe, boring, long-term investments, like ETFs that grow steadily over time and completely lock down your financial future. Then you have the satellite slice. That's just 10 to 20% of your portfolio. This is your fun money. You can use this small portion to safely experiment with short-term active trades. If you lose it, well, your future is still completely secure in the core. But if you win, hey, it's a really nice bonus. It perfectly satisfies that urge to actively trade without risking your entire retirement. It's the best of both worlds. At the end of the day, long-term consistency almost always beats short-term market timing. Unless you genuinely want a second, highly stressful job just staring at charts all day long, playing the long game is the proven, undisputed path to wealth. So I leave you with this. Are you currently investing for a short-term goal, or are you strapping in for the long haul? Take a hard look at your timeline, build your strategy around it, and keep building that compound machine. Let me know which path you're taking in the comments below.